Alternative investments play an increasingly important role in modern multi-asset portfolios by providing diversification, return enhancement, inflation protection, and access to unique sources of risk premia. This broad asset class includes hedge funds, private equity, private credit, commercial real estate, infrastructure, commodities, and other real assets. Unlike traditional investments such as publicly traded stocks and bonds, alternative investments often possess distinct return drivers and lower correlations with conventional asset classes. As a result, they can improve portfolio efficiency by reducing overall volatility while potentially maintaining or increasing expected returns. Investors increasingly allocate capital to alternatives to address challenges associated with lower expected returns and changing market dynamics. The diversity of alternative investments is one of their defining characteristics. Hedge funds employ a variety of strategies, including long-short equity, risk arbitrage, macro trading, and quantitative approaches. Private equity funds invest in privately held businesses or facilitate corporate restructuring and growth initiatives. Private credit involves direct lending and specialized financing arrangements outside traditional banking channels. Real assets encompass investments such as commodities, agricultural land, energy resources, timberland, and infrastructure. Commercial real estate provides exposure to income-generating properties and long-term capital appreciation. Because each category exhibits unique risk-return characteristics, investors can tailor allocations to achieve specific portfolio objectives while gaining exposure to economic opportunities unavailable in public markets. One of the primary benefits of alternative investments is diversification. Many alternative asset classes exhibit lower correlations with traditional equities and fixed income securities, allowing them to reduce portfolio concentration risk. During certain market environments, alternatives may generate positive returns even when public markets experience significant declines. Real assets, for example, often benefit from inflationary conditions, while some hedge fund strategies seek to profit from market inefficiencies regardless of overall market direction. Although diversification benefits can vary across economic cycles, the inclusion of alternative investments can improve a portfolio's risk-adjusted return profile. Consequently, institutional investors frequently incorporate alternatives as a strategic component of long-term asset allocation policies. Defining the investment opportunity set is a critical step in portfolio construction and asset allocation. Traditionally, investment opportunity sets were based primarily on asset classes such as equities, bonds, and cash equivalents. However, modern portfolio management increasingly recognizes the importance of incorporating alternative investments into the opportunity set. Expanding the opportunity set broadens the range of available return sources, risk exposures, and diversification opportunities. Portfolio managers must evaluate the characteristics of each investment category, including expected returns, volatility, liquidity, and correlation with existing holdings. A broader opportunity set enables more flexible portfolio construction and may improve the likelihood of achieving long-term investment objectives. The process of defining an investment opportunity set can be approached from either a traditional asset class perspective or a risk factor perspective. Traditional approaches categorize investments according to legal structures or market classifications, such as equities, fixed income, and alternatives. Risk-based approaches focus on underlying drivers of returns, including economic growth, inflation, interest rates, liquidity, and credit risk. By identifying the fundamental factors that influence performance, investors gain a deeper understanding of portfolio exposures and diversification benefits. Alternative investments often provide access to unique risk factors that are not readily available through traditional assets. This perspective supports more comprehensive portfolio design and more effective management of long-term investment risks. Despite their benefits, alternative investments present several challenges that must be carefully considered. Many alternatives involve limited liquidity, longer investment horizons, complex valuation methodologies, and reduced transparency compared with publicly traded securities. Investors may also face higher management fees, performance fees, and operational risks. Successful implementation requires thorough due diligence, strong governance structures, and an understanding of the specific risks associated with each strategy. Nevertheless, when incorporated thoughtfully into a diversified portfolio, alternative investments can enhance returns, improve diversification, and provide exposure to valuable sources of risk premia. Understanding their role and properly defining the investment opportunity set are therefore essential components of advanced portfolio management and strategic asset allocation.